So Ken, it takes a couple minutes for Clubhouse to push out all the invites for people to listen. So we can do small talk for a couple minutes, and then we'll start the formal program.
Sounds great.
Thanks everybody for joining us. As I just said, we're just wait for a couple minutes for invites to get sent out, and then we'll start in about 90 seconds or so.
So, Mark, I appreciate you having me here tonight. Look forward to the conversation.
Good. Yeah, us too. And I see the listeners. I see very interesting listeners.
It's a great time.
I think we'll have a good crowd. Let's see how we're doing. 1,200 people live coming in so far and ramping up fast. Good. Thanks everybody for joining us. We're just letting people roll into the room before we get started. 1,300 and counting. One of the things that Clubhouse really hits you with is the realization that actually going to physical conferences these days means you're almost always talking to a smaller audience.
Yes, that is true.
And the other thing is, in an actual conference, there are fewer people who are paying attention.
Yes, that's true. Okay, there we go. 1,800 and climbing. And then we will do I think our goal is to do we'll have a compliance edit pass on both sides, but hopefully a recording of this later on. Okay, good. We're at 5:02, so let's go ahead and get started. So, welcome back to our Ben and my irregular Clubhouse room, Unfettered Conversations. We are here today with a couple people. One is our partner Alex Rappel, who is a partner of ours at our firm, and I'll brag on Alex, is a world expert in fintech and all aspects of the financial system, and is very involved in many of the leading edge fintech companies. Trying to redefine the financial services landscape. And then our special guest today, who we're delighted to have, Ken Griffin, who is famously, legendarily, the founder CEO of a financial institution called Citadel. I will not provide a description of Citadel in my introduction because I want Ken to do that. We'll do that in a second, but we'll go through kind of the origin of Citadel, the role that it plays in the world, and in the global financial system. And then there are two exogenous events that have propelled Ken and Citadel into the spotlight in the last 12 months that are of keen interest to our audience. One is the entire kind of situation around GameStop and the meme stocks and Robinhood, and all the issues around that a while ago. And we will talk about that topic partway through here. And then the other is Ken has also been in the news recently for purchasing an amazing copy of the U.S. Constitution, and he was competing with a Web3 consortium called Constitution DAO, which only barely lost. And so, again, a topic of keen interest to our audience, and we'll also be talking about that towards the end. So for folks interested in those two topics, please hang with us as we go through the the industry stuff and the business stuff, and we will get to those topics. And so, let me start by saying, Ken, welcome to Clubhouse, and welcome to Unfettered Conversations.
It is a pleasure to be here tonight.
Good, fantastic. So I was thinking maybe we could start. One of the things we try to do here when we get the opportunity to talk to folks like you, who have built major companies, major institutions from scratch. Obviously that you've kind of done that in a different industry from the one that Ben and I usually operate in, but anybody who creates something of the scale and scope of the Citadel is somebody we're keenly interested in kind of hearing the story from. So I wanted to start by maybe asking you, could you maybe just start out for people who haven't heard of Citadel or don't know what it is, maybe give us kind of the one paragraph kind of thumbnail sketch of what it is, and then I'll ask you to kind of tell us about your origin story and then the origin of the firm.
So, Mark, Citadel and Citadel Securities are two of the largest participants in the global capital markets. Citadel is the firm that I back in 1990. That was very early at using quantitative investments in the financial markets. I had a background in software engineering. I was incredibly fortunate. I grew up in Boca Raton, Florida, which for the computer science history buff, IBM personal computer was developed.
Right.
And had one of the first PCs that came off that manufacturing line, which meant that I had to learn everything from assembly language to programming in BASIC or in later in C++. So I had a really just passion around the technology in the very early days of accessible to the average man on the street. In college, I studied economics and found that my passion around technology, around mathematics, could be applied in financial markets by building quantitative models to price various options like convertible bonds, like equity warrants, instruments that were a bit more esoteric, but where Wall Street had really yet to embrace the power of quantitative finance. And that was the origin story of Citadel back in 1990, was this belief that we could change how financial markets around the world worked by using what you and I today think of as almost commonplace tools and technology, but in a way that at the time was quite revolutionary.
Right. And how old are you when you started to kind of decode that there was maybe something big that was about to happen like that?
So I started to invest my freshman year in college, and it was really my sophomore year in college that I stumbled upon the arcane world of convertible bond. And in that world, I saw the opportunity to apply these concepts of quantitative finance in the financial markets. And so that was all the way back in like 1987. It was quite a while ago.
Mm-hmm. I think normally one would assume, I guess we're all kind of used to thinking about Wall Street being very sophisticated, and obviously it is in many ways. I would have thought, I guess, even in the 1980s, I would have thought that, what Renaissance was up and running by then. Is that right?
I want to say they focus on statistical arbitrage strategies in the early 90s, if memory serves me right.
You were there quite literally at the beginning then. The whole quant kind of phenomenon was just in the very nascent stages generally.
So what you found the large investment banks had built these capabilities in the fixed income product space. So for example, trading treasuries. You saw firms like Princeton Newport Partners that were in the space. But it was a variety of people who were off the Wall Street that were really starting to appreciate how the unfolding world of technology was going to change the financial services landscape.
Right. Yeah, there's a famous story. I don't know if you ever knew him. There was a guy, Ben Rosen. Did you ever meet Ben Rosen by any chance?
I didn't.
Okay, yeah. So Ben Rosen was, I think I have the story right, he was a legendary analyst for Morgan Stanley covering tech in the early 80s, and he's kind of the guy who basically he's like the guy who basically announced to Wall Street that the PC was coming. Back to your reference.
Yes.
And he wrote this research report, and he basically said there's this new thing called the PC, and everybody thinks it's basically stupid and useless, but there's this new software thing that's been built on it called the spreadsheet, and I think it might be a big deal. And of course, not only was he right about that, he went on to actually found a very large and successful computer company called Compaq.
Now that you mentioned Ben's background, I have met Ben before, and he was absolutely a pioneer. And of course, the Compaq personal computer, the portable computer, was like lugging your suitcase around.
Yeah, but nevertheless, it was a big breakthrough right at the time, right?
Extraordinary.
It's like a 35-pound briefcase with like a 4-inch screen. 4-inch screen in the original model, and
a 5.25-inch drive. So this is where we're dating ourselves, okay? Just to be really clear.
Yeah, exactly. So that was right in that era. And then the other interesting thing about your time frame on this is, so you were in the market as a, 19-year-old college freshman in 1987 during the famous, what was it, Black Friday crash of 87?
The crash of 87.
And so what was that like to experience, especially as somebody who was just getting started in finance?
It was an extraordinary moment to experience early in one's career. And I think it was an incredibly pivotal moment because having not deployed much capital, I nonetheless I had to see the carnage that the crash of 87 created. And moments like that create great respect for how markets can be incredibly volatile and turbulent.
Yeah, and so the way I've heard it described, and of course I've been through a couple of these now, but it's there's this whole concept of sort of like a liquidity crisis, right? Which is basically it just feels like basically the tide goes out, right? Participants in the market simply do, they either all want to sell or they don't want to trade at all.
So back in the late 80s, there was the theory of portfolio insurance, and you could have a large equity portfolio and manage your downside risk selling that portfolio as the market went down in price. And the only problem with this strategy was that there was so much money deployed using this strategy that when everyone tried to sell at once, there was simply no buyer at a brief period of time, and that really fueled the crash of '87.
Right. Yep. Yeah, exactly. By the way, if people haven't read the original paper on portfolio insurance, I read it a while ago, and you read it and you're like, wow, this sounds like a great idea. Why doesn't everybody do this?
Yeah. The old pathological condition.
Yes, exactly. So, Ken, then take us from that. Okay, take us from then those early days, and as with maybe Ben and me and a lot of people listening, like there's sort of obviously a right place, right time kind of aspect, but also like how did you then go from that to deciding to start your own firm, Citadel?
I'd like to sort of take right place, right time, the right toolkit at the moment in time to solve the problem that had yet to be solved. And I think an incredible number of our stories of great entrepreneurial success really come down to having the right toolkit at that moment. And I think it's an important distinction from right place, right time.
Well, and then the other implication of that, though, is that the incumbents, presumably the incumbents have just as much access to that toolkit as, a new entrant like Citadel does, right? And so you have the part of that puzzle then is why the incumbents don't immediately seize on the new toolkit.
But I think you've been doing venture capital long enough to know that innovation often takes place outside of the four walls of large companies. If you're a large company, you have incredible inertia or momentum in what you currently do. And to embrace a game-changing technology or framework is really difficult to do.
Yeah, I think we would call that in our world probably right product, right time. In the sense that, all the big companies could build that product too, but they don't.
Yes. Yep. Okay, and then Ken, how did you think about what business did you originally envision Citadel being in?
Well, ironically, when I was certain I'd end up in private equity. And it's been about 30 years, and I have yet to make that journey.
And so, why was that your original thought, and then what happened?
So I was very interested in what it would take to run a great business, and the opportunity to be involved in a portfolio of businesses, to think about how to improve those businesses, how to better the products, how to run the business better was incredibly fascinating to me. But once I commenced a career in trading and then started to build the business of Citadel, that became my passion.
Right. You could exercise that. Would you say it's still true to this day? It's sort of big finance, capital F finance, private equity, and sort of public markets are still like it's. Is this still the case basically that the great private equity firms are not necessarily great public investors, and vice versa?
It's two incredibly different skill sets that drive the success stories of your Fidelities and Capital Research versus your KKRs and Blackstone. And those differences in skill sets are important to helping us as a country and to corporate America to be competitive on the global stage.
Yep. Okay, and then maybe take us through the first few years of Citadel. Like, what were the steps involved in getting the company up and running?
So, the most important steps involved were, one was raising capital. And as you and I both know, founders without capital don't tend to go very far.
Yep.
And I was very fortunate to have been backed early in my career by a firm called Glenwood Partners here in Chicago. They were instrumental to the success story of Citadel, in that the two principals were willing to put their name on the line to investors to support what we were hoping to build here at Citadel. And then the second incredibly important factor was the willingness of people across Wall Street to take the time to explain and mentor me in the various concepts that were applicable to already. And this is a really special part about the culture of America, which is the people who are more advanced in their career to take the time to mentor literally strangers. Like if you present an interest in a problem and you present it well to a number of people who are leaders in their field, they'll take the time to walk through what their learnings have been, their observations have been, and to help you move ahead in your. And I was incredibly fortunate to have many people that at the large investment banks that would take the time to explain to me market opportunities, pitfalls, how I could be a better investor.
And is that, in your view, is that it sounds like, is that a distinctly American phenomenon?
I think that's an incredibly American phenomenon. You know, go ahead.
And do you think it's across industry? We have that in tech as well. But I've kind of heard, from some, in other industries, it's not as prevalent.
My suspicion is it's pretty broad-based. I would be hesitant to believe it's a tech or finance to think it's an American trait.
Another question I wanted to ask about the early years. So I remember 1990 quite clearly because I was in college and doing a lot of my original work at that time. And 1990 was a grim time for America, right? It was or at least how I experienced it. It was a grim time for the country. It was what the sort of Great Recession of that era was underway. There was this sort of very potent, like, rising political tide of populism, that led to, Ross Perot almost winning in '92. There was this sort of overwhelming feeling, or at least I can tell you in tech, there was this overwhelming feeling at the time that America's best days were behind it, and that basically Japan, at that time was sort of fated to take everything over. There were all these best-selling books talking about how Japan was the future of everything, and the U.S. was basically stagnant and failing. Stocks, I don't remember exactly what was happening in the stock market in 1990, but it probably wasn't all that pretty. Did you feel like you were doing something kind of counterculture in making a bet fundamentally on a system that a lot of people at the time were very down on?
It's a great question. So graduating college in '89, working to invest capital during things in loan crisis was a set of challenges I anticipated, obviously. And then you and I remember, every way or another was about rising sun, the rise of Japan, how Japan was going to dominate every single industry around the world. And we were actually a very active investor in the Japanese derivatives markets, largely because the Japanese had little understanding of the products that they were issuing to raise capital. And I actually took quite a bit of pride in being quite successful trading their markets and bringing some profits back home to America.
Those were the days. It was, I don't know, what was it? It was like of the 10 big global banks, it was like whatever, 7 or 8 were Japanese.
That or the Imperial Palace in Tokyo was worth a good portion of the entire value of the state of California.
Yep, that's right.
These were moments that are hard to even comprehend in any sense of the word. I mean, like how can you imagine the wealth that was in Japan on paper, and then how that tide pulled out and really left the United States in a very enviable position just 10 or 15 years later.
Yeah. Well, it was like by 1995. My memory is by 1995 it was if that had never happened.
Yes.
The U.S., the sort of U.S. 1990s economic boom, tech boom, internet boom were underway, and the whole Japan thing just went straight down the memory hole.
Well, it did, but it didn't. So, just-in-time manufacturing.
Yep.
That came from this moment in time.
Yep.
The entire Toyota production system, which has been studied by like every business school graduate, came from this moment in time. So Japan actually, a number of their incredibly controversial ideas to the world, and the best American companies embraced these ideas in their day-to-day business practices and became far better competitors.
Mm-hmm. Yep, exactly. Good. Okay, and then one final question on the early stages, and we'll move on to current events. So, when, if ever, this is kind of a loaded question to ask an entrepreneur always, but like, when, if ever, did you kind of have the moment where you're like, okay, this thing, my company is going to make it?
So I'm going to answer the question second. So we were talking about the early days and how we were active in trading in Japan. One of the best life experiences I ever had was that we ran a portfolio 24 hours a day when I was 21 years old. And that meant that I had to do two things. I learned how to extraordinarily talented people to put around me, and it meant that I learned how to trust these people that I had around me. And that's a really important lesson for all entrepreneurs, is to learn how to let go of the reins to people who are really good around you, and to how to empower them to make decisions and to build a business together with you as a partner.
Mm-hmm. Mm-hmm.
And then when did I say we'd made it? In some sense, I'm still waiting for that day.
Yeah.
Yeah. As soon as you declare that, you got to retire.
I think that's time to find a new occupation in life.
Yeah. Well, we've made it, but there is a turning point. There is a turning point when you stop. Well, I don't know. You tell me that was there a point where you're just like, okay, this thing is, whatever is going to happen, this thing isn't just going to go under. Like, this is actually going to be a thing that's going to survive. Or is that still something for you that's just that still kind of haunts you, that you just need to like be constantly on the lookout for things that might take the whole thing down?
I'll put this in perspective with a really real story. So November 2008, mm-hmm. the great financial crisis. Mm-hmm. And I literally remember walking into the elevator in my condo building and wondering if we'd be in business at the end of the day.
Yeah. Yeah.
I mean, the entire U.S. financial system was on the precipice of collapse. And if that had happened, we would have gone with it.
Yeah. And how many hours, the action that happened that kind of saved it, like, how many hours away do you think you were at one point, at the sort of worst point?
So I think that if ready for ironies, the Japanese were instrumental in providing capital to Morgan Stanley at the peak of the crisis.
That's right.
And if the Japanese had backed away from doing so, Morgan Stanley would have failed, and I think we would have failed the next day.
Yeah. Yeah. And by the way, right, not just Citadel, but also General Electric, and then like the rest of the Fortune 500.
It would have been the Great Depression for. And there's a great irony as we started with the story of 1990 in Japan. Thankfully, the Japanese had been great savers for all this time and had that to help provide Morgan Stanley with a lifeline when all of us in our country went.
Yeah. Yep, exactly. So, okay, well, that's a great answer. So you and I are blessed then. You and I, Ben and Alex, are all blessed to be in industries where we never get, we always have, there's always enough existential risk to keep us on our toes.
I had an opportunity with Jack Welch's right-hand man on human resources, and he was an advisor to me for years, an incredibly gifted man. And GE had a really interesting vantage point on the world because they would buy a company almost every day at their peak of their acquisition binge. And so they saw all kinds of businesses incredibly well run, businesses that they bought out of bankruptcy.
Yep.
And I asked him, what's it like in the four walls of a company that you bought out of bankruptcy as compared or contrasted to a company that was really well run?
Mm-hmm.
And he goes, I'm going to give you a story that's going to paint the picture for you pretty well. The great businesses feel like you're behind the wheel of a Formula One car. Mm-hmm. And you're flying down the straightaway, full power, 220 miles an hour into the curve. And you're just full on the brakes, the car's sliding out towards the wall. And just before you hit the wall, you're back on the gas going down the way.
Yep.
Over and over.
Yep.
And that was, frankly, a pretty disheartening moment because that's what the great businesses felt like.
Right.
I said, so what are the businesses that you bought out of bankruptcy feel like? He goes, picture a beautiful day in Texas, and you're in a Cadillac going down the highway at 55 miles an hour. That's what the business out of bankruptcy felt like. And everyone asked, how did this ever happen? And I realized then and there that business was about always being on your feet. And this sort of dream that we get to a promised land, it never...
Yeah, you never quite get there. Well, Steve Jobs used to say that. He used to say it, I think, aspirationally, the journey is the reward, which I think he meant at the personal level, but I think also is also at the level of the business.
I think it's true for both. And the journey is the reward.
Yeah. Good. So let's good. So we're about over a third of the way through the time. So I want to get to kind of current events. So and sort of the exciting stuff. So you have Citadel Asset Management, where you invest capital, the sort of way that you form the business and scale the business, and then you have this business, Citadel Securities, where you serve as what's called a market maker, where you're sort of a part of the sort of key trading infrastructure of how these markets work. There is, as you well know, there are many hedge funds and private equity firms and so forth, and certainly venture capital firms that invest for decades and never have their own market making businesses. Yours has been a huge success, which we'll talk about. But what made you decide to get into that business?
So we were at the epicenter of the movement leading to electronic moves. And that played right to our core competency of predictive analytics and of risk management and of steering. So again, it goes back to having the right tools to solve the problem of that moment in time. In the 1980s, when I started trading, all your trading happened with people on the floor of the New York Stock Exchange. And today, you have people on the floor of the New York Stock Exchange, but the vast majority of trading takes place through electronic matching engines that align buyers and sellers in a almost hyper-efficient way. And we had the toolkit to build that was going to excel at providing liquidity in this brave new world of electronic and automated trading. And that's the Citadel Securities.
Yep, got it. And then maybe you could describe for people who kind of don't know what this is, and we're going to get into the GameStop saga here pretty quickly. But and I also want to, by the way, introduce our partner Alex, who's been on the line, and I want to also let him be asking questions here also. And actually, as background, so Alex is also an expert in this space, and Alex was on the board of a company called Night Capital, which I think was in a similar business. And so you guys together know a lot more about this than I do. So, what led Citadel at one point, or I think to this day, let's say as we like to say, robust market share, has been very successful in this space. Like, what do you think? What were the things along the way that caused the sort of outlying level of success that you've had in this business?
So I think, first of all, it goes back to, at our core, it's our strength in predictive analytics. It's understanding where the prices of securities are heading to and being willing to commit our capital to help market in the right direction. So if we think that oil prices are going up and airline stocks will be going down, we're willing to commit our capital to buy oil and to short airlines at that moment in time. And we do this on a massive scale around the world. In fact, we trade about 1 in 4 shares that trade every day in the United States, providing liquidity and helping to bring equilibrium to the market by deploying our capital. The core of the business is again, it's the predictive analytics. This sits in a cocoon or infrastructure of extraordinarily high performance technology, because we have to incorporate literally millions of data points over the course of minutes into our trading decisions. And that requires an incredibly powerful computational backplane to do so. And then the portfolios that we instantiate or that are created by people trading with us, we have to manage the risk of those portfolios in real time, and in particular in fast changing market conditions. So think about the start of the pandemic in March of 2020, the amount of information that we had to incorporate into our decision and put it to a market that was undergoing incredible stress.
And then Ken, we're about to launch into GameStop, but it's just for I think lots of people are experiencing. Unfortunately, we're having still some connection issues. So your team has requested a moment where we maybe try to reconfigure your audio. So
right.
let's take 30 seconds to give you a chance to do that.
Sounds great. Let's do that.
So folks, just bear with us, and we'll get to the GameStop topic in a second.
1 in 4 trades. That's amazing.
Yeah. The scale is gigantic.
Good Lord. I mean, it's a market maker, but still.
Well, and I can say from my perspective, so I remember I was on the board of a company called KCG, which was the merger of GetCo and Knight Capital. And Knight Capital was a very successful market maker that had a little trading error, lost $500 million in about 10 seconds, and then basically went under, but was rescued by a consortium of firms. And I remember when Citadel, and Ken, maybe you could talk about this, but when Citadel got into this space, I was curious at the time. KCG just kept losing money. It was not a good business. It eventually merged with Virtu. Citadel has done extraordinarily well, and obviously a lot of this is the tech advantage that you brought. But I guess I am curious, like, how did you think about this from asset management? Is itself extraordinarily profitable? Like, we love to invest in recurring revenue SaaS businesses. Asset management is effectively a recurring revenue business. If you just manage enough assets, you're going to have a great business there. Market making is taking a lot of risk. So I guess, how do you think about the benefits of not combining the two, because obviously they're separate, but just if you think about both of them, how do you allocate your time? How have they both become so successful, even though they're very separate?
Mark?
And yep. Hey, Ken.
Please tell me this is better.
Yep, so far so good. Sounds good.
Great.
You sound great.
It's a bit of deja vu. There was a conference call that we held during the great financial crisis of 2008. And you're going to laugh at this. We had to arrange the number of people that could be on the call. And we arranged for more listeners than a typical Goldman Sachs earnings call. And right here at the moment of the great financial crisis, where we're going to tell our story of how we're getting through this moment in time, we had an open call. You could dial in to hear us speak, and they actually crashed the entire teleconference system. So it's great to be here in 2022 or 2020 when we can make this work with thousands of people almost flawlessly.
Yeah, our version of that is, the startup team that comes in to present us, and they're doing, absolutely state-of-the-art deep learning AI, big data, like the most advanced quantum computing work in the world. And then, of course, in the first 20 minutes, we can't get the projector to work.
Yes. Yes.
So we'll all get there. Anyway, did you by chance hear Alex's question?
I didn't. I was offline for a moment.
Oh, sorry. Okay, yeah, Alex, please go ahead.
Yeah, sorry about that. I guess I picked a bad time to ask the question. So I was saying, I was on the board of KCG, which is, kind of merger of GetCo and Knight Capital. Knight Capital was kind of a disaster in that it was a leading market maker until there was a little trading error or snafu, and then it blew up. I was always curious why Citadel got into the business, because I think of asset management as being such an incredible business because it's effectively recurring revenue. If you think of a SaaS company, it's like you get the same revenue every year. You're managing lots of assets. It's a lot more predictable. Market making, you're taking a lot more risk. And how do you think about the balance between the two? And honestly, like from the KCG perspective, it's like we kept losing money in that business forever. It was not a good business. You've turned this into an incredible business. So I guess kind of two-part question. One is, how do you think about why, if you could be so great at asset management, why do this other thing as well? And the other is, what has been the secret to success? I know it's technology, but if you can go into a little bit more, that would be great.
So, first of all, I think it's important to be clear that our asset management business is driven mostly by our performance fees, which are our profit sharing with our investors. So when our investors make money, we make money, and when our investors don't make money, we get paid very little. And this alignment with our clients puts us in a position to be laser-like focused on both identifying opportunities and managing the risks of the portfolio. So unlike most of your traditional asset managers, we're in a very different business in terms of having to be just continually focused on how do you have in the marketplace a competitive advantage in identifying mispriced assets and opportunities around the world. So that brings us back to the core of our market making business, which is around predictive analytics. In the hedge fund, we spend an incredible amount of time forecasting where we think, for example, the price of natural gas will be in the United States, where the 10-year bond yield will be a month forward. Think about that mindset of forecasting future prices and bring it into a very short-term horizon, say the next day or the next 4 hours, and then apply those forecasts in thinking about how you manage the risk inherent in a portfolio that is given to you in your capacity of providing liquidity to the marketplace. So at 100,000 feet, we're in the forecasting business. And in the hedge fund, our forecasts tend to be forecasts that are measured over weeks or months. And in the market making business, those forecasts are thought of as being measured in the course of minutes, hours, or days. But at the core of both of these businesses is very much a focus on predicting what the future will be. So, for example, in the market making business, you'll see technologies like machine learning being used to build your forecasts of future stock returns.
Got it. Good. So let's dive right into GameStop. So kind of, if I'm going to start just by because GameStop was a little while ago, so I'm going to just do a quick. There's a little blurb here on Wikipedia, and I just start by saying I don't represent. By no means do I represent what's on Wikipedia as the truth, but rather just sort of as an expression of kind of the gestalt of the commentary. Especially around that time, and just to kind of refresh people who have kind of fuzzed out on the details. So, January 25th, it was announced that Griffin Citadel would invest $2 billion into Melvin Capital, which was the hedge fund that had suffered losses more than 30% on its short positions, particularly on GameStop. On January 28th, Robinhood, an electronic trading platform favored by many traders involved in buying GameStop stocks and options, which, by the way, my firm's involved in, abruptly announced that it would halt all purchases of GameStop securities except to cover shorts, and would only allow those securities to be sold if already held but not sold short. So in other words, Robinhood cut off basically the ability for the retail traders who were torturing GameStop and Melvin Capital at the time from being able to trade. The price of GameStop stock declined steeply shortly thereafter because Robinhood receives a substantial portion of its revenue through a payment for order flow relationship with Citadel Securities LLC. Many commentators criticize the potential for a conflict of interest where the same entity plays the role of market maker and also participates in the market that it makes. And of course, in this case, also was a major investor in the hedge fund on the other side of the GameStop situation. So I wanted to start, and obviously, please critique any of that that's false. But just more generally, I would love to hear, and I know everybody would, kind of from your perspective, basically, like what happened? Like, what is the true story of what happened during that period?
So, in broad strokes, Melvin Capital was short a variety of stocks that became of interest to rather savvy and sophisticated retail investors who realized that the amount of stock short was just disproportionately large relative to average daily trading. Mm-hmm. And these retail investors, realizing that there were these unduly sized short positions in the marketplace, started to buy these stocks that caused the hedge funds that were short these stocks to start to incur losses. And, when firms are losing money, they almost reflexively start to cut their own risk. So in this case, they start to cover their shorts, and you end up in this reflexive pattern that as retail's buying the stock, pushing it higher, the hedge funds that are short are covering their shorts, pushing the same stock price higher. And this virtuous circle becomes incredibly painful for the hedge fund managers that are short the securities of interest. And we saw this virtuous circle playing out in the marketplace. And on the day that we invested in Melvin, we thought that this had run its course. Mm-hmm. In fact, it was very clear in the morning of the day that we made the investment that this short squeeze was apparently dying down. And we invested money into Melvin to take advantage of the fact that a number of their shorts had become very inflated in price, and we expected those prices to revert in due course, and we'd have made a successful investment. Right. And at that moment, the world changed. We had the social media landscape with some very important influencers really lit up on the story of GameStop as being a stock to get long and to ride to the moon. Yep. And Melvin continued to cover their short very aggressively over probably the next 48 hours, give or take. I can't remember the exact timing of this. Now, ironically, I'm almost certain that Melvin had covered their entire short before the 28th. In fact, they put out a press release. The press release would give the exact timing of it. I don't recall that off the back of my hand, but I'm pretty certain that by the time that Robinhood stopped trading on the 28th, Melvin had already covered their short and moved on.
And basically just taking the losses would be the way to think about that, right?
Yeah, they'd taken their loss and they moved on.
Yeah.
I mean, part of what good risk managers do is when they're wrong and they can't understand what's taking place in the marketplace, they take it on the chin, they take their loss, and they move on. Now, Robinhood had a distinctly different problem than Melvin had. They had a problem of too much success. Robinhood had opened accounts with millions of retail investors who, seeing this price dynamic playing out in GameStop, seeing some of the really important influencers in financial markets advocating the purchase of GameStop, we saw an absolute deluge of retail buyers of GameStop unlike anything I think the markets have ever seen before. The problem this created for Robinhood is this very concentrated position of buying required them to post good faith margin with the clearinghouse that everybody on Wall Street uses. And I believe that good faith collateral requirement was order of magnitude $3 billion.
Yeah, that's right.
Of cash.
Yep.
And Robinhood simply didn't have $3 billion of shareholders' equity to draw on to post that margin. And so, because of their incredible success, they needed to restrict trading at that very moment in time where I'm certain they would have wanted to continue to trade to gather the revenues associated with trading, but they couldn't because they had to let some of those purchases work their way through the settlement cycle to release the demands for cash collateral. And of course, as you know, Robinhood was out trying to raise capital at that moment in time to generate more cash to give them the flexibility to make the margin calls that they had to make.
Yeah, and in fact, you may know our firm participated in that round, in that sort of injection.
And I'm certain that was a successful investment for your firm.
Yeah, that was good. There's a couple of kind of claims that have, kind of went viral around that time that I think, probably are still circulating around. So yeah, one is this kind of idea, so this idea that on the one hand, you've got this relationship with Melvin Capital where you're now a big investor. On the other hand, you've got this relationship with Robinhood, where they get a lot of their revenue from payment for order flow through your market maker. And so there's this perception developed that you're kind of sitting in the middle of this web and kind of pulling strings, and then there's this kind of shadowy consortium or whatever they call it in the background, and they're issuing this overnight demand for money, and that's presumably like somehow rigged up by Wall Street. So like how do you kind of process through what was your reaction to kind of finding yourself in the spotlight on that kind of thing, and how do you kind of process through trying to explain to people what the reality of the situation was?
Well, I have to say that processing conspiracy theories is not one of our core competencies. So we were a bit slow out of the gate to dispute this ridiculous set of claims, just given we don't find ourselves in the middle of conspiracy theories very often. So as a large market maker, in fact, the largest market maker in the market in late January, in GameStop, in AMC, in the other meme stocks, we were very interested in seeing the continuation of trading both buys and sells. One-way flow is a really difficult proposition for a market maker. all you do is you've got one-way flow. So if people keep selling you stock, you keep accumulating inventory. What are you going to do? You make your money as a market maker from the bid-ask spread of buying and selling, getting into and out of a security over the course of a day. Mm-hmm. So we, as a market maker, we're the largest market maker in this period in late January because of our operational capacity to take on the operational risk and capital demands that were inherent in this incredible increase in participation by retail investors. Mm-hmm. So in contrast to Robinhood, we had the financial strength to meet our collateral calls. We had the operational bandwidth to meet the demands of the marketplace on our business. Mm-hmm. And then with respect to Melvin, as I spoke about it earlier, their short in GameStop was, to the best of my knowledge, like already gone or virtually gone. It wasn't even in our minds on the day of the 28th. Like, we didn't even think about it. And so the fact that people made that connection ex post was certainly not a connection that I'd made a priori.
Got it. Right. So you were sitting there thinking we have to optimize the value of this investment. We just made it in Melvin Capital.
No.
Okay. And then there's two just absolutely and then I want to let Alex ask more detailed questions, but there's just two things that are just that I actually learned. I knew kind of intellectually, but there's something I knew intellectually, but didn't realize kind of emotionally or viscerally until I saw it happen, which is you can if you are short a stock, if you're a fund and you're short a stock, you cannot, and Ken, correct me if this is wrong, you can't close out that short without delivering that stock. Right, which is to say, like, I can't, if I'm short whatever and it's whatever, I offer you $100 to close out the position, $500 to close out the position, $1,000 to close out the position, $10,000 to close out the position. I can't close out the position without the actual share of stock because because basically there's in theory potentially a limited downside if the stock keeps rising. Is that technically true?
So for 99.99% of situations, of which this was one of that 99.99, you had to buy the actual shares back if you were short and trying to cover your short. Mm-hmm. So for all intents and purposes, one should view if somebody's short a stock, they're going to have to one day buy those shares back in the marketplace as a regular way trade.
Mm-hmm. By the way, just out of curiosity, what's the 0.01% exception?
Sometimes professionals over the years, I've seen people willing to settle a short for cash in lieu. Mm-hmm. But that's almost always the context of things like tender offers for a company.
Okay. Right.
So if a company's being bought for for cash, let's call it, General Electric's going to buy a company, they're going to pay $24 a share. Once the tender closes, if you were short that stock, since the tender's closed, the company's been bought, you can, under those circumstances, settle your liability for cash.
Yeah. But what you're describing is a particular kind of bounded situation with presumably minimal risk. In contrast,
the shares are gone, the company's been bought, and how do you wrap up that contractual situation amongst the parties?
Right. But if there's unlimited potential future downside, you can't get a counterparty who will settle you out for anything short of the actual stock.
If one of the challenges that you have as a short seller is your risk is unbounded,
right?
And so that's why when people are constructing portfolios of longs and shorts, their short positions tend to be much smaller than their long positions on a relative basis, because the risk on the short side's unbounded in comparison to the risk on the long side positions.
And then that leads to the second thing, which I called up the GameStop stock price. I get the terms GameStop stock and stonk confused in my head all the time now. But the GameStop stock price, we're sitting here now, almost a year later, and it's still the market cap of the stock price is still $179 a share. Which is up, is up 1,000% from a year ago, and the market cap of the company is almost $14 billion. And if you look at the chart, it's not quite, it's not at the all-time high that it got during the truly crazy period, but it's not that far off. It kind of peaked out at over 300, and it's still at 179. It certainly hasn't fallen back to where it started. are you surprised that? And I guess but I guess the logical implication of that is there are still the suggestion I think that price might be telling us is there are still funds out there that are short that haven't been able to buy back, and the Reddit horde is still torturing them, or is there some other explanation for, or maybe the company's, by the way, much better, right? Is the other possibility? But like, are you surprised that stock has held up? Because I think a lot of the commentary at the time was obviously this thing is going back to near zero.
Well, I think it's an incredibly complicated situation. First of all, the management team of the company did a great job of buying back its own stock, ballpark 2 years ago at much lower prices. So the company bet on its own future and bought back a fair number of shares. I think it was in the single dollars per share back, roughly 2 years ago. And that's rough strokes. I'm not a GameStop expert per se, but my memory serves me right. That's what they did about 2 years ago. And then there's been the rise of a significant new investor, the founder of Chewy, and he has an incredible reputation as being an entrepreneur and of really understanding how to connect with the consumer in a profound way in an e-commerce environment. And if somebody's going to figure out how to turn GameStop into a successful e-commerce based platform, he'd be behind the list of people to do it. And that's the question. Can they pivot from a huge footprint of stores around the world with a relatively high cost of distribution to an e-commerce led company with a broader mandate that's able to engage the consumer in a profoundly different way? And the market price today reflects people's views on that very same question. The current short position in the stock is actually quite trivial compared to what it was just a year and change ago. Virtually all the short players are long since gone from this name. They've given up trying to understand how to price GameStop with the founder of Chewy at the helm.
Yeah. If you look at, by the way, if you look at the 5-year chart, it looks, pardon the metaphor, it literally looks like a corpse that suddenly came back to life. It's just this flat sag for like 4 years, and then there's this crazy spike, during the Reddit drama, and then there's this kind of choppy, but like fundamentally, as you said, kind of this kind of new normal, at least for the last 9 months.
The question here is, and I play my Xbox. I just got Call of Duty Vantage. I downloaded it.
Yep.
I didn't walk into a store.
Yep. Well, I mean, that was the presumption, right? Prior to the Reddit guys figuring out the short situation, right? That was the presumption, right?
That was the presumption. The presumption was the world was going to go to digital downloads so fast that GameStop would not be able to change its cost structure quickly enough to adapt to that brave new world, and they were going to meet the same fate as Blockbuster.
Yep.
Right. And Blockbuster actually dates you and I once again. Like videotapes to a lot of people are just like they see them in movies. They don't actually know that we actually went to Blockbuster and used to rent them.
Well, there's a new Netflix movie coming out to pour salt in the wound. I think Netflix is making a movie. I think it may just have come out called the Last Blockbuster. And it's literally a movie about the last video rental store. So at long last, they've they're spiking the ball in the end zone. So
that is pretty funny. And so the question is will the management team at GameStop find ways to connect the consumer that are different than what they were doing 3 or 4 years ago, that create value for consumers for which they get paid to do?
Yeah, and then
go ahead.
Good. Well, the reason I brought this up, the 5-year chart, is it goes to the point you made. I just want to explore one more level, which is, this is a situation, like you can tell a very different story here. And the story basically is they had this, they were in trouble. Then they had this exogenous event caused by, the mechanics of the stock market. And then to your point, like they have seized, in the best case scenario, they've seized on the exogenous event to now construct a better future for themselves.
No doubt. And
right.
they raised a tremendous amount of capital.
Right.
To create a war chest that gives them the flexibility to pursue a variety of different business strategies.
Yeah. And so it's like this unusual reverse move, though, where it's like and by the way, we see this in our business, and it's speculation creating reality, right? Like potentially in a really positive way.
So the markets will judge that in retrospect. Were the people that bought GameStop stock from the company over the course of the last year brilliant or not? And we'll find out based upon the success, the failures or success, the merits of where GameStop takes their business.
Yep. Good. Okay.
By the way, that's what makes America's capital markets work. Differences of opinion drive our capital markets. Just remember, a few months ago, Hertz was left for dead in the middle of the pandemic. They were in bankruptcy. And they went to raise money in the stock market, and the SEC said, you can't do it, an offering, you're bankrupt.
Yep.
Right? And now Hertz is this incredible success story.
Yep.
So I think we have to all have some level of humility about our ability to forecast how any given company is going to progress, prosper, or fail.
Well, I think that's one of the great things here is that it turns out retail is very smart. Sometimes called retail dumb money, but actually, and I mean, smart on Tesla, smart paradoxically on something like Hertz, which was bankrupt, and potentially smart on many of these others. One of my favorite things is if you Google Apple IPO Massachusetts, there's an article in the Wall Street Journal about how the state of Massachusetts, to protect the general public, banned their participation in the Apple IPO, which is, of course, now the biggest company in the entire world. So it turns out sometimes retail investors are smart, and I would argue that right now it's a better time to be a retail investor than ever before.
I think it's always important to remember that a number of your retail investors they're intrinsically optimists, and when they see a great product run and a company run by an inspired CEO, they're willing to put their money on that. They're willing to believe in the future of America. They're willing to believe in the Tesla story.
Yep. And get rewarded appropriately, and motivate more entrepreneurs to build more companies like that.
Mm-hmm.
Yep. Good. Okay. Look, I would love to keep going. We have, we could go for hours on this, but we're coming close again to the end of your time. So I wanted to I want to ask you about the other thing you've been in the headlines for recently in our world, as well as more generally, which is your purchase of the U.S. Constitution and your competition. And you're just very narrow, I think, trouncing, but your trouncing of the Constitution DAO Web3 project that got a lot of attention. A consortium of Web3 crypto people that were trying to buy the same Constitution. So maybe tell us a little bit about that. How did that go down from your perspective?
So first of all, it didn't go down. The Constitution is one of the most sacred documents in the history of our country. And as many of you are aware, I have a great passion in governance, in public policy, in how to make sure that America stays the land of opportunity. It's incredibly important to me. It's a huge focus of my charitable activities is to broaden the safety net in America, to create opportunities for people to go to our finest schools, to ensure that America continues to be really that shining light on top of the hill. And so when that Constitution came up for sale, I actually saw it several weeks before the auction. And it's one of those moments I walked out of Sotheby's and told a friend, I'm going to buy that. Because to own such an important part of the history of America, and really just the profound wisdom of the words transcribed on that paper by the thought leaders of our nation, that was truly important to me. And then nothing like seeing the Constitution DAO raise just a mind-blowing amount of money in a few days in front of the auction.
Mm-hmm.
And what a statement about community.
Mm-hmm.
I mean, I am blown away by the passion of the community to come together to share this document with our country. And just as I will share this document with our country, I was really impressed to see so many Americans willing to put up money to make that happen as a reality. And so the night of the auction, what I've learned over the years in auctions, simply the person willing to pay the most wins.
Yep.
There's no grandeur in being the winner at the auction. You're just willing to pay more. In fact, you might be saying you're the person willing to pay more than anybody else in the world at that moment in time. That's not always where you want to be in life. But I was fortunate enough to have the financial resources to acquire the Constitution. And as you're well aware, I've already committed to lending it to Crystal Bridges, where it will be shared with, hopefully over the next few years, millions of Americans. And Crystal Bridges is a really special place. It touches touches the Midwest in a profound way, it touches the South in a profound way. A huge number of the people that go to Crystal Bridges have never set foot into an art or history museum before in their lives. And to really share the American vision with so many people, I hope is an inspiration to our youth about the greatness of our country, about the greatness of our founding fathers. And we didn't get everything right, but we changed the world, and will inspire people to pursue both public service and to pursue how can they make America better.
Yep. When do you think, where exactly is that, and when do you think people will be able to go see that?
So it's going to Crystal Bridges. I don't have their opening date yet, but it will be early in 2022.
Got it. That's fantastic. That's great. Hopefully a lot of people go. I would love to go see that. Good. So I can't think of a better way to end the conversation, and we're right at 6. So Ken, want to thank you for your time and for getting into these exciting topics with us, and we really enjoyed having you.
What a pleasure. Great to be with both of you tonight. Thank you so much for having made the time.
Good. Awesome. Fantastic. And thank you everybody in the audience for joining us, and we will be back. We'll be back soon.
Okay, thanks so much. Thanks, Ken.
Great.
Thanks, Ken.
Great. Good night, everybody.
Thanks, Ken.